Mutual funds are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. They are managed by professional fund managers who make investment decisions on behalf of the investors. Here is a simple breakdown of how mutual funds work. Structure: mutual funds are structured as trusts or corporations. When you invest in a mutual fund, you purchase shares or units of the fund. The value of these shares is based on the net asset value (NAV) of the fund, which is the total value of all the securities held by the fund minus any liabilities. Diversification: mutual funds offer diversification by investing in a wide range of securities. By pooling money from many investors, mutual funds can invest in a diversified portfolio of stocks, bonds, or a combination of both. This diversification helps reduce the risk associated with investing in individual securities. Professional management: mutual funds are managed by professional fund managers who have expertise in analyzing and selecting securities. Fund managers make investment decisions based on the investment objective and strategy of the mutual fund. They aim to generate returns for the investors by actively managing the fund's portfolio. Investment objectives: mutual funds can have different investment objectives, such as growth, income, or a combination of both. Growth funds focus on investing in stocks with high growth potential, while income funds aim to generate regular income through investments in bonds or dividend paying stocks. Balanced funds seek a balance between growth and income by investing in a mix of stocks and bonds. Types of mutual funds: there are various types of mutual funds available to suit different investment preferences. Some common types include equity funds, bond funds, index funds, sector-specific funds, and target date funds. Each type of fund has its own investment strategy and risk profile. Fees and expenses: mutual funds charge fees and expenses to cover the costs of managing the fund. These fees may include an expense ratio, which covers the fund's operating expenses, and sales loads or transaction fees, which are charges when you buy or sell fund shares. It's important to understand the fees associated with a mutual fund before investing. Liquidity: mutual funds offer liquidity, which means you can typically buy or sell your shares on any business day at the fund's current NAV. This provides flexibility and easy access to your investment, unlike some other investment options. Performance and returns: the performance of a mutual fund is measured by its returns over a specific period of time. Returns can be influenced by factors such as the performance of the underlying securities, the fund manager's decisions, and market conditions. It's important to review a fund's historical performance and compare it to appropriate benchmarks before making an investment decision. Risk: like any investment, mutual funds carry risks. The value of your investment can fluctuate based on the performance of the underlying securities. The level of risk varies depending on the type of fund and the investments it holds. It's important to assess your risk tolerance and choose funds that align with your investment goals. Research and selection: before investing in a mutual fund, it's important to research and evaluate the fund's performance, investment strategy,